Hey everyone, I'm Andre with JVM Lending. I'm here to talk about some common myths that are keeping people on the sidelines and why I think they shouldn't. So just a quick overview of what we're going to cover today. Number one, why there's no crash coming. We see this all the time from pundits and the crash bros online that this is just like 2008 and home values are about to come down. And we don't necessarily think that's the case. Number two is why rates aren't that high, especially from a historical perspective. Number three is why waiting will actually cost you money, especially when you take that longer view approach. And last but not least is talking about the real freedom that comes with owning your home, all the things you get to modify, control, and make your own. So the first thing, the first myth that we hear a lot of is the housing market is going to crash like it did in 2008. This is a popular thing to repeat from a lot of pundits, especially online. There's a ton of fear and engagement for clicks, and we don't necessarily think that that is reflective of the housing market today. So on the next slide, I want to talk about the single most important chart in real estate and use this chart as a filter for all the news you're getting in about the housing market. And if it fails to address this simple point, you can probably write it off as something that's fear-mongering or not necessarily fueled by real data. So here it is, the single most important chart in all of real estate. So what you're seeing in the solid blue line is the number of households in millions over the past few decades in the US. So we started at around 80 million in the 1980s and have been steadily increasing to about 135 million households. And a household is a unit of people living together, whether they're renting or they're owning. It's one group, married, unmarried, whatever. Doesn't matter, just that they occupy the same space. And then in the dotted yellow, what that's showing is the number of housing starts, so the number of new homes being built in millions since that time. So you can see even in the 80s, when there were only about 80 million people, we were still building around 1.25 million new housing units every single year. And then that kind of fluctuated up and down a little bit, but it was always kind of in that higher 1.5-ish million range. And then the gray bar shows the recession, the great financial crisis and recession of 2008. And after that, you can just see the housing starts fell off a cliff. And now we've been in the 500,000 to maybe a million range year over year, despite the fact that the number of households in the US continues to rise. So that's leaving a humongous deficit between the number of homes that are being built and are made available to families to purchase or to occupy versus the number of households that need to occupy somewhere. So we're literally millions of units short from what we need. And this is the most important thing to understand. Without an oversupply of home, without more homes on the market than how many people need them, there is not going to be this crash in values because there's just not the oversupply to drive down housing prices like we saw in the great financial crisis. I'll also add that in 2008, that was the only recession in which home values actually declined. Generally, home values tend to hold or even increase a little bit during recessions because it brings down interest rates and borrowing costs. So that's another interesting phenomenon. But that aside, just the raw numbers of units to number of households is a huge disparity that you need to understand. Another way to measure the shortage in housing units is by months of supply. This is a real estate industry term. So it's a little bit different than what you might see day to day, but the way that that's measured is in months, how many months it would take to absorb all the units on the market. So in 2008, at the pace at which homes were selling, it would almost take a year to absorb all the inventory that's on the market. Today, we're looking at 3 to 4 months to absorb all the inventory of homes on the market. And a healthy market or an average is about 5 to 6 months. So even by this measure, you can see that we are undersupplied with the number of homes and well short and far, far away from the number, from the oversupply of inventory that we had in 2008, which is really what drove down a lot of those values. So another thing that is important to understand is the difference in lending standards today and just the general economics of that market. So in 2008 or post 2008, there were a lot of reforms that were passed, especially in the lending space. So if you've gotten a mortgage recently or applied for a mortgage, you might have gotten a little bit overwhelmed with how many documents and information was requested from you. And that's because the standard has gotten so much higher for who qualifies. Before the financial crisis in '08, you were able to buy investment properties with no money out of pocket. You were able to, regardless of credit score, no income, no job, no assets, they would still issue a loan. And that is not the case today. There is a requirement for lenders, especially on a home that you plan to live in. There's a requirement that lenders prove your ability to repay that mortgage. And that usually revolves around showing that you have enough income that's stable and steady that can be used to make the housing payment. Another huge variable here is the equity that people have in their homes. So right now, homeowners are sitting on a record amount of equity, about 40% equity in their property, meaning that if they have a $500,000 home, they might only have a mortgage of $300,000 or less on that property. And so that gives them a huge cushion in value. So even if prices come down a little bit, they're not pressured, or sellers aren't pressured to panic sell because they're not underwater or upside down on their mortgages like many were during the 2008 crisis. And finally, just to drive this point home, I mentioned already twice, but the supply shortage is just a formula for home prices holding or at least being really stable, because we don't have that oversupply and we do have a lot of demand and a lot of new household formation. So the next myth that we hear a lot of is that interest rates are way too high. There's no way anybody can buy. And the reality is that interest rates, while they're higher than the lowest rate we've ever seen in the US, which we just passed by in the last 5 years, by historical standards, they're actually pretty normal. So here's a look at what interest rates have been like since the 80s. Throughout the decade of the 80s, they were around a 13% average. Then they came down to about an 8% average. In the 2000s, they were 6%. The 2010s, about 4.5%. And now we're back up to 6% after, of course, that nice little dip we had where we bottomed out with the lowest records ever. So the 2 and 3% interest rates that we're seeing during 2020 and 2021 are definitely not the norm. What is the norm is what we're seeing today. And it's actually indicative of a healthier market that we're within, or at least in line with the historical interest rates that we've had previously. And we're not at some artificially lower rates that are, basically being pushed down through government spending and government intervention. So if you're waiting for rates to drop, they might still come down. There's a lot of information, especially on our website, if you're reading our blogs, that talk about what might drive down interest rates a little bit further. But when we're talking about rates coming down, we're saying they might come down to the low 5% range. We're not saying that there's a lot of data to support rates coming down to that 2 or 3% level pretty much ever. So this is more or less where we are in the sweet spot. And especially today, which is, I'm filming this in January of 2026, we are at a recent low. So even as of a year ago, we were closer to 7% interest rates, and now we've actually adjusted down. So relatively speaking, we are in a time where people are refinancing and getting lower payments than what they were able to get even just 12 months ago. So the right way to think about interest rates is not that you're going to get the rock bottom lowest interest rate ever, but think about it long term. Real estate is not a short term speculative play. That was, definitely the attitude people had in the pre-crash timeline. So in the 2005 to 2008 was definitely like this. I'm going to put my money, double my money, sell it, get a bigger house, etc. That's not how houses should be treated. This is a long-term investment. Home prices appreciate over time. So I can't necessarily feel very strongly about what home prices might do in 6 months or 9 months, but in 6 to 9 years, I'm feeling a lot better about what we might see from the housing market, and historical support for values is very strong for that time. So the common thing to remember is that it's not timing the market or trying to get the exact right time where rates are the lowest and prices are the lowest, because that time really doesn't exist. It's the time you spend in the market, buying something that's the right size for you, that you can afford, that's right for your family, that you can stick with for 5 to 10 years and give the market time to build that equity and appreciation for you. If rates drop, you're always eligible to refinance. That's another beautiful thing with mortgages, is that you can essentially swap it out for an interest rate that's lower and save on that monthly payment. Our clients are always eligible for that with us, and we keep our eye out for opportunities for them to refinance. The one thing you can't do is rewind the clock and get today's price in 10 years from now. As inflation and appreciation continues its trend, it's not likely that we're ever going to see prices at these levels, especially the longer you wait. The nice thing is also you lock in your payment with a mortgage. So when you're purchasing, whatever that payment is, especially on your loan payment, that is fixed for 30 years. Yes, there can be changes to insurance and taxes and other things like that, but the bulk of your payment, which is going through the bank, is generally locked in for a really, really long term. And therefore, you're not going to see any fluctuations with rental like you would with rental prices or things like that, that are outside of your control. And last but not least, whether you own or you rent, you're paying somebody's mortgage. And if you're renting, that's generally paying your landlord's mortgage off, where wouldn't it be better if that money was going to yourself and being saved in your own equity for your own future? The third myth that we hear a lot of is that home prices might drop, so I should wait. The reality is that home prices have been consistently rising over time, even when you factor in the crash of 2008. As a whole, we've seen prices continue to steadily step up. So here we're looking from 1991 through today. These are median prices for the US. So obviously, real estate is hyper local, so this might not be at all relevant to the area you're in, or it might seem extremely high or extremely low based on where you're looking to purchase. But as a general trend, especially because of the way inflation has been pushing up everything, home prices are one of those things that tends to be an inflation hedge, meaning home values tend to increase with inflation. So you can see from 1991 to today, there's basically a $300,000 increase on the median value of homes in the United States. So that is a pretty good return on investment, if you ask me. Of course, you could, talk about tech stocks and other things like that, but what you can't do is you can't live inside of your stocks. So homes have a lot more utility or a lot more usefulness to us than just beyond the economic values of them. And that brings me to my last point, which a lot of home ownership, we can talk about the economics, we can talk about the investment value, but ultimately home ownership is freedom. It's not just a place you live, it's yours to control. It's something you get to pass down from generation to generation. So think about the longer picture, the bigger picture for yourself and for your life. You're going to get that stability where your payments aren't going to be changing all the time. What is that going to mean for your budget in 5 years where, as wages and everything else rises with inflation, if your housing payment stays roughly the same? You're able to build wealth. We see that the wealth for homeowners is far higher than the wealth for renters. And as always, there's exceptions to the rule. But in general, it's a great way to force yourself to save by putting money into your home's value and watching that grow. You get to control the space. It's yours. There's no permission slips needed. Well, maybe permits if you want to do big additions, but you have the control to make the home exactly the way you want it, feel comfortable and have that freedom inside of it. And the legacy you get to pass on. So generational wealth generally starts with real estate, having something of value you can pass along to the next generation. So we want to be here to help your future start now. It's not always the right time today, but it is the right time to start educating yourself and knowing your numbers, knowing what's possible, and knowing some of the programs out there, because those do change from time to time. So even if 6 months or a year ago you were told no by somebody else, that doesn't mean that no is forever. And there are likely things that we can do to help you get closer to home ownership, whether that's going to mean you're 1 week closer or 1 year closer. We want to make sure it's within your grasp. So if you're on the fence or still thinking about these different options, feel free to talk to us. Our consultations are completely free, not going to cost you anything. You don't have to do a credit check. We just want to understand your financial picture, help make some recommendations to help you get there. And more often than not, when we dig into the numbers, people find that they might actually be closer to being able to purchase than what they actually thought. So if you'd like to schedule some time with my team, reach out to us at jvmteam@jvmlending.com. Again, we'd be more than happy to help, and we would love to help you start your future now. Okay, have a nice day.